Imagine staring at your retirement account after 40 years of breaking your back, realizing you are still thousands of dollars short of survival, and suddenly spotting a single stock offering a massive 12% cash payout. It is late at night, the kitchen is quiet, and the glow of the screen offers what looks like a financial miracle. For the exhausted worker desperate for a win, that double-digit dividend yield feels like a lifeline thrown into rough waters. It promises passive income, a steady stream of money arriving like clockwork, enough to finally let you rest. The numbers sit there on the page, huge and intoxicating, whispering that financial independence is just one click away. You see other companies paying a measly 2 or 3%, but this one stands tall, offering a massive return that could instantly cover the mortgage or pay for the groceries. It looks like the undisputed heavyweight champion of the market, a towering giant ready to fight for your future. You imagine the relief, the heavy burden lifting off your shoulders as you prepare to trust this giant with your life savings. But that towering number is not a promise of wealth, but a siren song luring unsuspecting investors toward rocks hidden just beneath the surface. When a dividend yield stretches far beyond the average, the mechanics of the market have fundamentally shifted from opportunity to extreme risk. The system is no longer operating on strength and steady growth, but on a mathematical distortion that traps those who only look at the surface. In the brutal arena of the stock market, an unusually high payout is rarely a sign of immense power. It is almost always a blaring distress signal, screaming that the company is taking on heavy damage behind closed doors. You might think you are buying into a thriving business sharing its massive profits, but you are actually stepping into a trap set by desperation. The giant yield is a mask, a fake painted-on smile designed to hide deep structural wounds from the public. That painted smile tricks thousands of honest people into handing over their hard-earned cash just as the foundation begins to crumble. The company is bleeding out, losing customers, drowning in debt, or watching its core business become entirely obsolete, yet it keeps the dividend artificially high to maintain the illusion of health. It is a dangerous game of survival where the unwary investor becomes the collateral damage, caught holding a worthless ticket to a fight that was lost before the bell even rang. The heartbreaking reality of this trap lies in the cold, unforgiving math of how a yield is actually calculated. A dividend yield only measures the cash payout against the current price of the stock, meaning there are two ways that percentage can climb. The healthy way is when a thriving company decides to share more of its growing profits, but the tragic way is when the company is failing and its stock price is violently crashing down. As the stock price plummets toward zero, the dividend percentage mathematically skyrockets, creating a terrifying optical illusion of value. The massive 12% yield you see on your screen is not a reward for your loyalty, but the direct result of institutional investors and insiders frantically dumping their shares and fleeing the arena. The smart money has already smelled the blood in the water and rushed for the exits, leaving behind a bloated artificial number to tempt the desperate and the uninformed. This mechanical illusion of wealth, built entirely on the collapse of the underlying business, sets the stage for a profound human tragedy. The trap is fully set, waiting for the exact moment when logic is overpowered by the sheer exhaustion of trying to get ahead. It is a profound mystery of human nature why we so often choose to ignore the glaring red flags right in front of us. Spotting a failing company with a massive yield is like looking directly into the swollen, unfocused eyes of a battered fighter sitting on the stool between rounds. The damage is entirely undeniable, the breathing is ragged, and the legs are gone, yet the crowd still desperately wants to believe in one last miraculous knockout punch. Hope blinds us to the brutal reality of the situation, especially when our own survival feels like it is on the line. Good, hard-working people refuse to see the blood on the canvas because admitting the danger means accepting that the easy way out does not exist. They cling to the promise of that massive payout, convincing themselves that the market has simply made a mistake, entirely unaware that the final devastating blow is already in motion. To understand why a giant yield can be a death sentence, you have to look at a number called the payout ratio. Think of the payout ratio as a fighter's stamina in the late rounds of a grueling match. It measures exactly how much of a company's earnings are being handed out to shareholders as dividends. When a business makes $1 and pays out 40 cents, it has plenty of energy left to train, rebuild, and grow stronger. But when a company starts paying out 90 cents or even more than $1 for every dollar it earns, it is starving itself just to stay standing. This mathematical starvation is a tragic mechanism that plays out in slow motion. The business is bleeding out its core strength to keep the crowd cheering. They are draining the very funds needed to fix broken equipment, hire better talent, or develop new products. The payout ratio strips away the illusion of the high yield and reveals a desperate fighter running completely out of gas, swinging wildly while ignoring the toll on their own body. Once that stamina is completely gone, the inevitable collapse becomes only a matter of time. Behind the closed doors of corporate boardrooms, a profound and silent suffering takes hold of the business. The executives act like panicked cornermen between rounds, whispering desperate lies to themselves and the public. They refuse to cut the dividend because they know the moment they do, the illusion shatters and the investors will flee. So they keep the payout artificially high, slapping a quick bandage over a deep wound to make everything look fine for the cameras. Underneath that expensive bandage, the core business is quietly rotting away. Warehouses go unmaintained, crucial research is canceled, and the competitive edge dulls to a rusty blade. The management team is sacrificing the entire future of the company just to survive the current quarter, trapped by the heavy burden of a dividend they can no longer afford to carry. The longer they hide the internal damage to protect the payout, the more devastating the final blow will be for the people holding the stock. To see through the lies of the cornermen, you must measure the actual vital air in the fighter's lungs, which in the financial world is known as free cash flow. This is not some clever accounting trick or a hopeful projection of future earnings. Free cash flow is the real, cold cash left in the company's pocket after the lights are kept on, the workers are paid, and the factory floors are swept. It is the pure oxygen that keeps the business alive and moving forward. Without a steady stream of this fresh air, the company is suffocating under its own weight. When you compare the total dividend payment to the free cash flow, you get the single most honest number in all of investing. If the dividend costs more cash than the business actually brings in through its doors, you are watching a champion gasping for breath, completely unable to defend itself against the next heavy hit from the market. This is the exact moment the trap snaps shut on the unsuspecting investor. Lured in by the promise of a massive yield, the hopeful buyer steps right into what the market calls a value trap. They believe they are stepping into the ring with a legendary champion whose stock is simply trading at a temporary discount. Instead, they have bought a ghost, a hollow shell of a company trading entirely on past glory and borrowed time. The realization hits with a sickening drop in the pit of the stomach. The high dividend was never a reward for loyalty, it was bait. As the stock price continues its relentless slide downward, the investor watches their initial money vanish, entirely wiping out any small comfort those outsized dividend checks might have provided. The illusion of a discounted champion fades the moment you realize the trap has already snapped shut, leaving you holding a ghost of a company. This is where the tragedy reaches its darkest phase, a desperate scramble to keep the high payout alive by simply borrowing the money. It is the corporate equivalent of a broken fighter taking dangerous painkillers in the locker room, desperately trying to numb a shattered hand just to survive one more round. The core business is no longer generating enough cash to reward its investors, so management turns to the banks, taking out massive loans to fund the illusion of prosperity. Every dollar borrowed to pay a dividend is a heavy weight added to the company's shoulders, a debt that steals away the future to pay for today. Instead of investing in new equipment, better products, or stronger defenses, they burn their credit just to keep the crowd cheering for a little while longer. The yield on your screen might look magnificent, but it is entirely artificial, fueled by borrowed time and mounting obligations that will eventually come due. That artificial strength only accelerates the inevitable collapse as the interest payments on those desperate loans begin to bleed the company dry. Now the story enters the quiet, agonizing rounds just before the final bell where the math simply stops working. Step by step, the debt mountains grow too steep to climb, the cash reserves vanish into nothing, and the executives run entirely out of maneuvers. The earnings reports become tense, silent affairs filled with vague promises and hollow reassurances that fail to mask the bleeding balance sheet. The market senses the weakness, pushing the stock price even lower and driving that dangerous dividend yield even higher into the red zone. It is an unbearable tension, a heavy silence hanging over the ring as everyone watches a proud giant swaying on its feet, completely defenseless. The money to maintain the payout is gone, the credit lines are maxed out, and the brutal reality of the situation can no longer be hidden behind clever accounting. In these final, suffocating moments, the board of directors is forced into a corner where only one devastating option remains. Then comes the knockout punch, the brutal morning when the news finally breaks and the company announces a massive dividend cut. The payout that lured so many hopeful investors is suddenly slashed to pennies or completely wiped down to zero in a single ruthless stroke. It is a breathtaking violence that rips through the market the moment the opening bell rings. The stock price plummets instantly, crashing toward the canvas as panicked shareholders rush to the exits, desperately trying to salvage whatever value is left. The high yield that looked like a guaranteed fortune vanishes into thin air, leaving behind a shattered stock that is worth a fraction of what you paid for it. The trap has executed its final punishing blow, destroying both the promised income and the core wealth you worked so hard to build. The dust settles over a ruined portfolio, the once glorious yield replaced by the stark, silent reality of a total financial defeat. When the payout vanishes, the real damage is not recorded on a balance sheet or tracked by a stock chart. The fallout is measured in quiet, crushing moments inside living rooms and kitchens. It is the sudden realization that the reliable income meant to cover basic living expenses is simply gone. A 12% yield that looked like financial freedom suddenly becomes a canceled trip to see grandchildren. This is the profound, silent grief of trusting the wrong numbers. For someone who spent decades saving and planning, a slashed dividend often means a forced return to work at age 70, trading hard-earned retirement years for a uniform and a time clock. The dream of a secure, peaceful future is shattered in an instant, all because a dangerously high number blinded them to a dying company's reality. Surviving this trap requires a complete shift in how we look at income, moving away from the dangerous allure of the highest number and stepping into the careful, deliberate work of finding true strength. The rebuilding process is painful but vital, demanding that we look past the shiny double-digit yields that scream for attention. We have to start examining the actual health of the business, beginning with its lungs. In the financial world, those lungs are free cash flow, the actual money left over after the company pays its bills and keeps the lights on. If the cash flow is the breath, the payout ratio is the stamina. We must measure exactly how much of that breath is being exhausted just to pay the dividend. A healthy company might use half its energy to reward its owners, saving the rest to grow and protect itself against hard times. But when you see a company paying out 90 or 100% of its cash, you are watching a fighter gasping for air in the late rounds, lacking the stamina to survive the next blow. Reading these vital signs correctly transforms a fragile portfolio into a fortress, filtering out the desperate companies before they can ever do harm. We all want the easy victory, that massive overnight payout that promises to solve every financial worry with a single decision. But true resilience means facing the hard, boring truth that lasting wealth is built slowly, deliberately, and safely. It is a profound personal duty to look past the dangerous temptations of the market and become the vigilant protector of your family's future. Refusing to chase a reckless yield is the ultimate act of discipline, ensuring the money you fought so hard to earn remains secure for the people who depend on it most. The lasting legacy of the dividend trap is a permanent shift in investment strategy, moving millions of retirees away from individual stock picking and toward heavily regulated broad market index funds. This massive migration of wealth fundamentally changed the mutual fund industry, forcing institutions to create entirely new categories of low volatility, dividend appreciation products designed specifically to prevent catastrophic income loss. The scars of those losses remain deeply etched in the communities of the working class, where the evaporation of a single legacy company's dividend permanently altered the retirement timelines of entire factory towns. Families who once relied on those quarterly checks to pay property taxes were forced to downsize, leaving behind generational homes because a corporate board on Wall Street could no longer afford the illusion of prosperity. The year 2020 served as a brutal awakening for income investors worldwide, acting as a massive stress test for the entire financial system. In just 12 months, global dividend payments fell by over $120 billion, exposing the fragile reality behind dozens of high-yield traps. This historic collapse was not just a temporary disruption, but a fundamental breaking point that shattered the old illusion that a massive yield equaled a safe harbor. The market was forced to confront the reality that many of these towering payouts were built on a foundation of debt and fading revenue, completely unable to withstand a genuine economic shock. The aftershock of those widespread losses changed the core assumptions of how true wealth builders operate today. Investors stopped blindly trusting the flashy double-digit percentages that were actually acting as desperate warning sirens. Instead, the focus shifted entirely to the cold, hard mechanics of corporate survival. The new standard demanded absolute proof of life, forcing people to look past the advertised yield and examine the raw free cash flow and the sustainable payout ratios. The entire landscape of income investing evolved from a reckless chase for the highest immediate reward into a disciplined search for endurance, punishing companies that borrowed money just to keep up appearances. True financial independence is never found in the dangerous thrill of a massive, temporary payout that eventually collapses under its own weight. It is built on the quiet, unglamorous endurance of a healthy business, delivering a steady, unbroken stream of cash that silently protects your family's future long after the closing bell rings.